The day. David Forrester, G10 currency strategist at Macquarie Group, joins us this morning. David, I guess that is the big question. Can the weakness in the yen last, especially with moves being unilateral instead of coordinated?
That's a good question. Thank you for having me on the show today. In terms of the yen, there's a lot of talk about being a safe haven currency. I think that we have to look here at what is going on in terms of real interest rates. That's very important for things such as sovereign wealth funds and other reserve managers. And real interest rates in Japan are quite high relative to what we're getting in the US and QE. So unfortunately, we've got to take into account two factors here. First of all, those real interest rates, and second of all, at the end of the day, we've got the Fed pumping out plenty of money. So unfortunately, it's a unilateral intervention, unlikely to last.
Unlikely to last. Well, the finance minister Azumi in Japan says that the yen's levels at those post-war highs do not reflect the economic fundamentals. So where are we going with the yen? Is it going to go straight back down, back to 75 levels and beyond?
At the end of the day, BOJ intervention is designed to slow the trend moves in dollar yen, and we think that it will stay around the sort of 76 level. Now, there are a couple of reasons for that. First of all, we do expect, given it is unilateral intervention, unlike that we saw following the earthquake and tsunami earlier in the year, that the intervention will not last, or the impact of that intervention will not last. Secondly, we do expect better US data going forward, and that US rates will start to move a bit higher, not on account of the Fed, but on account of the data looking a bit better. So that should support the dollar yen. So we still think that 76 level is a nice level for the dollar yen to stay around.
All right, David, since I got you, before I let you go, let's talk about the Australian dollar. What's pushing the Aussie dollar higher today, considering some are expecting an interest rate cut coming from the Reserve Bank of Australia?
Well, it's a very finely balanced decision today. I certainly don't think it's the 80% in favour of a cut that the OIS market's reflecting. At the end of the day, I think markets are a little bit nervous ahead of this meeting. We're seeing a cutting of short positions ahead of the RBA meeting, so things are squeezing up. Macquarie is looking for a rate cut today, so the key thing will be the rhetoric of the RBA, and we actually think it could be a little bit less dovish than the markets expected, which could reduce the aggressive rate cut pricing we already have into the bills curve there, and actually give the Aussie a bit of support following a rate cut.
Really? Okay, so best bet in the currency markets, is it the Aussie going forward?
Well, we think that international events will actually dominate, and given that Macquarie as a house has a bit of a negative China data view over the coming few months, that's going to be bad news for the Aussie. So we actually prefer to sell Aussie on rallies.
All right, David, thanks for your time today. Good to see him. David Forrester, Macquarie Group, joining us from Singapore.